first quarter of the year is behind us. Let's take a look at how Sifter funds performed. Welcome aboard. Last year autumn, the sentiment in the investment market was uncertain, and for good reason. In January this year, investors' appetite started to grow and as the market began to look further into the future, even though the possible economic downturn had not yet begun. Speculations about the easing of inflation also brightened investors' mood. At the end of the last year, we conducted a thorough evaluation of Sifter's portfolio companies, and as a conclusion, we believe that the quality of Sifter portfolio is particularly good. Our companies are healthy and their business models and competitive advantages are in good shape. The stock market also noticed this, and it showed in January when the price of Sifter portfolio rose by 4.3% and continued with a 1.4% rise in February. In March, the price of Sifter fund accelerated by additional 3%. All in all, the first quarter of the year was excellent for Sifter investors, producing a total rise of 9%. This increase was even 3.6% better than the world index altogether. Although we are extremely pleased that the quality company strategy is working so well, we never try to guess the stock price changes in the future. The only thing we can promise is that as a Sifter investor, you own very high quality companies around the world that Sifter team constantly monitors. When we look at the key business metrics of the companies in the Sifter fund, we believe that we have succeeded in finding very strong businesses. The table shows the median figures of the companies in the Sifter portfolio realized during the last 12 months, which shows that the turnover growth, for example, has been 11% growth during the year. This means that our companies are growing. The operating margin of 26% also indicates a strong ability to make money and that the increased costs have not eaten into the results. The table shows the return on invested capital as well, which has increased by 22% over a period of more than 5 years. Well, this gives us a confidence that the management of our companies has invested profitably in developing their own businesses. When a company makes a fair profit, it practically has 3 options to share its results. Give them as dividends to the owners or buy own shares, make acquisitions, or thirdly, invest more in business growth. As long-term investors, we especially like the fact that a capable management finds good investments in its own business, which enables a growing profit in the coming years. In our opinion, this is how the best quality companies operate, and that is why we like high returns on capital. Maybe a few words about the troubles in the banking sector. In early March, we heard strange news from the United States as Silicon Valley Bank suffered liquidity crisis, which also spread to Europe, leading Credit Suisse to such a poor condition that UBS Bank bought it for themselves. Sifter had learned from the 2008 financial crisis that we no longer want to invest in bank stocks. The decision paid off now. Therefore, the problems of banks do not directly affect Sifter investors, although they can indirectly affect uncertainties in the economy and stock market. At the end of the video, I will give a brief assessment of what kind of companies the uncertainties in the banking sector could possibly affect. Let's take a look at which companies in the fund performed the best during the quarter. The top performers in the fund were the West Pharmaceutical Services, Taiwan Semiconductor, Lam Research and Applied Materials. We are quite pleased that our new investments in West Pharmaceutical and Applied Materials have performed so well. We were able to buy them at a discount price during the last year's bear market, and now the prices are beginning to reflect the quality of these companies. For example, West Pharmaceutical operates in the growing pharmaceutical industry and specialized in producing rubber components for medicine bottles, making it a market leader in its own segment. As we well remember, in 2022, the stock prices of many semiconductor companies fell sharply, even up to 50%. Investors around the world predicted that demand for semiconductors, such as chips, would decrease this year. Well, we saw things differently, especially in the long term, where we believed demand for semiconductors will grow significantly. Therefore, we didn't sell our semiconductor stocks, but instead decided to buy them at a discount price. Applied Materials and BE Semiconductor, among others, became new investment in our portfolio. In a similar way, the stocks of US ICT giants like Microsoft and Alphabet Google fell sharply last year, partly due to the rising interest rates. We didn't sell these companies, but we also didn't buy more of their stocks. Well, both companies' stocks have recovered quite well from their worst declines, although Alphabet's business is still overshadowed by uncertainty about the advertising market outlook and the potential impact of Microsoft's ChatGPT AI as a potential competitor. This all reminds us that a share price decline doesn't necessarily make a business worse. If the share price of Microsoft falls, say, 25%, does it mean that the company's business is 25% worse than before? Well, no. It only means that the market is willing to pay less for the company at the moment. However, sometimes the market is wrong, especially in the short term, and this might provide a good buying opportunity for a long-term investor. The biggest fallers in the first quarter were Johnson & Johnson, Automatic Data Processing, Nitori and Canadian National Railway. It's good to remind oneself that Johnson was one of the best performers last year, partly because pharmaceutical companies operate as a defensive stocks in bear market. Now, as growth stocks have risen in the early part of the year, Johnson has fallen. In line with Sifter's investment philosophy, the quality of Johnson's business has not deteriorated by 15% despite its price decline. It is true that Johnson is not a high-flying stock, but on the other hand, owning it provides the Sifter portfolio with good protection during volatile times. Well, in addition, Johnson also offers a nice 3% dividend yield, which is a good bonus for investors. Other fallers included Automatic Data Processing, Canadian National Railway, and few others. Although their stock prices have been declining since the beginning of the year, we believe that there has been no deterioration in the long-term business operations. What actions did we take during the quarter? As I mentioned earlier, at the start of the year, we invested in a new semiconductor company called BE Semiconductor, headquartered in Amsterdam. The company is specialized in semiconductor equipment manufacturing, and it is a market leader in its niche segment. We see many quality characteristics in its business and potential long-term growth in the company. We will provide more information about BESI's business during the springtime. We also made 2 sales. Both companies were from Japan. We owned Koito Manufacturing for 7 years, but after in-depth analysis, we decided that the company no longer meets the criteria of a quality company. Koito operates as a subcontractor in the automotive industry, specializing in car lighting. In our assessments, it's quite difficult to make money in the automotive value chain because margins are squeezed so much. We also sold our stake in Nitori Holdings, in which we invested in spring of 2021. The original investment hypotheses for the company were correct, but the Japanese home decoration market weakened somewhat, and the company's outlook for its business no longer encouraged us to hold the company's shares. So we moved the money from Nitori to better quality companies. Let me share a few words about the markets. Most investors are concerned how the market will develop in the future. In hindsight, it is always easy to see that the last fall would have been a good time to invest in equities, when stock market was down. Sifter Fund also has risen almost 15% since last fall. However, psychologically the decision is difficult when there is so much uncertainty in the media. The one thing we have learned in our 20-year history is that in the short term, investors focus too much on stock prices and macroeconomic outlook. Since we believe it's almost impossible to consistently beat the stock market in short term, we have chosen a long-term quality game. In this investment style, we must ensure that we own strong and healthy companies, and as investors, we are willing to tolerate stock price volatility and keep our investment focus far enough on the horizon. Well, this is why we never give investment advice, well, because we don't have any. What we have learned in the previous crises and market crashes is that very strong businesses perform well, and typically their stock prices recover faster than weak businesses. In history, investing in stocks have been profitable, even when buying at the peak of the market, and if your investment horizon is over 10 years. Well, the only certain thing is that the uncertainty will continue in the market for sure this year, and in our view, investors will increasingly value healthy companies. In our assessment, the ongoing uncertainty regarding banks will favor debt-free companies, as loaning new money might not only become more difficult but also more expensive. This is, of course, due to the fact that banks will be subject to even more regulatory supervision in the future, which will incur additional cost for banking sector, and finally this will also be reflected in the fees charged by banks. As mentioned earlier, we don't invest in banks since their earnings models are not interesting to us. Sifter companies, on average, are debt-free, meaning they have more cash in hand than loans. For example, the S&P 500 companies have an average net debt to EBITDA ratio almost 2x, meaning that they have almost 2 years worth of EBITDA in debt. We think that the current situation in the market rewards a risk-averse investor. We even see that the quality strategy like Sifter Fund benefits from the current macro environment. Although I'm biased to say so, my own money is invested in the Sifter Fund, and it gives me the safest feeling. Thank you for joining us.